Hello, and welcome to Money Spoke Financial Education. My name is Casey Hull, co-founder of My Money Spoke and certified financial planner. Today we're going to be discussing investment strategy. Before we dive in, please note that this is not a recommendation and is purely just meant to be educational. If you want personalized advice, please go to mymoneyspoke.com, complete the questionnaire, and our team will personally pair you with an advisor that's best suited to meet your needs. But yeah, let's jump in. So investment strategy. What is an investment strategy, right? An investment strategy is designed to guide an investor's investment decisions. A lot of it is based on a few key characteristics that you can see over here on the left. We want to always include the goal, the time frame, a person's risk tolerance, their full financial picture, as well as the tax status of the account being invested. Once an investor has clearly defined what each of these are and what they're comfortable with, it's time to start architecting the portfolio. So what I mean by that is it's time to create an asset allocation, right? Asset allocation. Now, an asset allocation aims to balance the risk and reward characteristics appropriately to your goals, time frame, but what it does is it divides your money into three major asset classes. The first being stock, the second being bonds, and the third being short-term equivalents and or cash, right? The reason you would do this is because each of these asset classes has different return and risk characteristics associated with it. So just to kind of illustrate that for you very quickly here, if we're looking at, let's say stock is blue here, a stock historical performance is going to look a lot like this, right? So it's got high potential for return, but there's a lot of volatility mixed within here. If we're looking at bonds as being green, for example, they kind of waver, never really getting you as high of a return, but never really giving you as much of a loss. And then cash or cash equivalents, CDs, are basically just flat guaranteed rates of return. They're probably the least risky investments that you could choose. But we want to have some composition of these to match what your goals, time frame, risk tolerance are. Now, a great illustration of this, in addition to the poor drawing I just gave you, is looking at what Fidelity, this is a great brochure from Fidelity, they give you all the major classifications of asset allocations, starting from the most conservative here on the left, being all cash or cash short-term equivalents, and then moving to the most aggressive, which is a composition of 70% domestic U.S. stock and 30% international stock. Now, within this chart, what you can see is the average annual return of each portfolio listed out here at the bottom. But in addition, if we're looking at the most aggressive portfolio, you can see the best one-year performance is at 162, almost 163%. The worst one-year performance being at almost 70% down. And then it also shows you the best 5-year and the worst 5-year time frame. So this chart really does a good job of illustrating the more you have in stocks, the higher potential for overall return, but also the higher potential for loss. So I think that chart does a really good job sort of depicting what you might be looking for and matching that up with your goals and time frames. But in this example, let's just say that we're balanced, right? So we have a combination of stocks and bonds that's roughly 50%, right? So now you have half your portfolio here, half your portfolio here. We'll just ignore short term for now, right? So great, we got 50-50. What's next, right? So now it comes down to an investment selection and diversification, right? So just as the risk and reward characteristics of stock and bond vary, so do the risk and reward characteristics of different types of stock and different types of bonds, right? So we want to make sure that you're diversified across all of the major asset classifications within stock as well as bonds. So to just sort of illustrate that here and give you some examples, so for stock, right, one of the major classifications is U.S. large cap. Now, what does this mean, right? This just basically just means the largest U.S. companies One of the indexes that makes that up is the S&P 500. That's 505 of the biggest U.S. companies, right? There's also mid-cap U.S. There's also small cap, right? When we're looking at equity, we also want to include a portion of international. And then maybe something a little bit more speculative, or what I like to refer to as dart throws. This could be emerging markets. This could be, Bitcoin. This could be something much more speculative with higher than average risk and return characteristics. You would usually make this a much smaller portion of your total portfolio. But we want to do the same thing with bonds as well. So as we're looking at bonds, there's also different classifications, right? So you have U.S. government bonds, right? You have high yield bonds. You have obviously international bonds, right? There's treasuries, and then municipals. Let's just say for our taxable accounts as well. We can get into that in another segment. But this is basically just a broad general outline of sort of how you could construct a 50-50 portfolio. Now, within that, obviously, I mentioned there were 505 different U.S. large cap stocks, right? So you don't just want to go and buy, let's just say, Apple, for example. Right, you want to also diversify within this entire segment of your portfolio, right? So an easy way to do this is to utilize index funds and ETFs, right? They tend to be very low cost. They're not actively managed. They're going to give you the broad index of each of these subsections of your portfolio. So that way you're not just buying Apple to consist of your large cap holding, but you're actually buying a portion of all 505 of those companies. So it makes it a little bit easier to create the portfolio. Now, great. So you put in all this hard work creating this and figuring out what positions you're going to use. Now you're finished. Sit back and watch your money grow, right? Just kidding. The work has only just begun. Unfortunately and fortunately for us, markets move, right? So let's talk a little bit about that as we dive into this. So when I say markets move, right, so you built out this beautiful portfolio. When we're looking at the markets over a long period of time, right, so this axis will be time. And if we're looking at just a standard market cycle, right, so we have a big ebb and a flow here. Let's say you invested your portfolio roughly 10 years ago at a 50-50 mixture like we just discussed. You got fully diversified. You included all the positions, right? Well, over the last 10 years, and actually just before I jump into this, it's going to be good to point out the relationship between stocks and bonds. When we look historically at what stocks do, right? So when stocks are going up, historically speaking, we see the relationship where bonds are going down or are just not performing well. Same thing when stocks are going down, we generally see bonds performing well. So we'll just represent that with an up arrow and then just say these two are inversely related, right? So if we look back at the chart, you invested 10 years ago at a 50-50 clip. You sat back and you watched your money grow, right? Well, you did see it grow because equity has absolutely dominated over the last 10 years, right? So what's happened, though, is half of your portfolio, this half here represented by equity, has grown substantially faster than the other half here. We've even seen some international bonds go into negative rates recently, right? So what does this mean for your portfolio? Well, it means over a 10-year period, because one half has grown faster than the other, you are no longer 50-50, right? You are probably sitting somewhere closer to 70-30 equity to bonds, right? Which is good because you've made a lot of money during this period of time. But unfortunately, if the market does choose to correct, and we'll just represent this with red, if the market does choose to correct and come down, you are now overweight the area that just got hit the hardest, right? So what does that mean for your portfolio? Well, it means that you've flip-flopped again, right? So now your composition has changed. You are probably somewhere close to 70% in bonds and 30% in equity, right? So you've lost a bunch of money here. You did really, really good. Didn't do anything. You lost a bunch of money here. Now the real problem of this, and the kicker to it all, is the market always recovers historically, right? But now, as the market moves into the recovery phase, you are underweight the area that's about to do well and overweight the area that's about to do poorly, right? So this presents a problem. You no longer have the horsepower to get back to where you were. So this is why we very, very strongly believe in what is called rebalancing. Now, rebalancing is very easy to understand conceptually. It is very hard to actually perform in real life. There's a number of reasons why, time being one of them. But I would say, in my experience, what I've seen is the emotional component is probably the most difficult for people to handle, right? So as humans, we're sort of inherently motivated by fear and greed, right? So let's just take, for example, if you took that Apple position I referred to earlier, and you saw Apple over the last 10 years double, triple, quadruple in value, right? You come into my office here at this point, and I tell you to sell Apple, you're going to look at me like I'm absolutely crazy, right? Now, keep in mind, I'm not telling you to sell all of it. I'm just saying, hey, we need to get your portfolio composition back to this 50-50 mixture to prevent you from experiencing a more substantial downfall than what you originally set out to do, right? So I think the idea is just throughout the entire market cycle, you need to be keeping your portfolio roughly 50-50 because as we look back, that is what you set out to do here, right? So you said, hey, balance is where I'm at. I'm comfortable with this rate of return. I'm comfortable with this type of volatility. That's where I want to be. At this point, you wouldn't be if you hadn't been rebalancing throughout the entire cycle. So I think that's one of the hardest things that we see people struggle with throughout. So I think the key takeaways, you want to make sure you're in the right asset allocation to begin with. You want to make sure that you're using the appropriate investments, preferably index funds and ETFs, to keep your costs low and to keep your rebalancing simple. And then you want to be actively monitoring your account and then making changes over time to keep with what you originally set out to do. So that covers investment strategy, or the basics of investment strategy. If you have questions, please reach out to us at contact@mymoneyspoke.com. And if you want specific recommendations, again, please go to the advisor section of mymoneyspoke.com, and we will personally get you paired with an advisor. But that concludes today's lesson. Thank you, and we'll be in touch next time.